All right, then let's take a look at this market picture. It certainly has turned positive, and that's despite the fact that we do have the trade war still happening between the United States and China. We got word yesterday that U.S. President Donald Trump said he doesn't want to meet with China right now, but of course, China coming back today and even saying that they're going to find a way to retaliate and serve the best interests of companies that, of course, are within their realm, and that includes Huawei Technologies, who earlier this week the United States decided to put even greater sanctions on. So that's bound to hurt the relations between the United States and China. Plus, we also got word from the United States Fed saying that things aren't turning out as positively as one would have hoped. There will indeed be a slowing in the way of the growth picture for the U.S. economy. At the same time, 1 million is how many unemployed payment marks are still being claimed out in the United States. So that's certainly hurting the market as well. But despite all of that news, though, we still saw the market go up, particularly out in Asia. More than 1% gained for the Hang Seng out in Hong Kong, with still some steady gains as well for the Shanghai Composite in China. They're going up more than 0.5%. It hasn't completely filtered through to the European market, though, so you're seeing a bit of a mixed picture on that front initially, but now it's gone all down, really. The FTSE 100 and the CAC 40 in France going down as well, while the DAX is pretty flat at this point in time. They were less than 1 point into that weakened picture. On the South African front then, the JSE All Share is up 0.5% this morning into this afternoon's trade. Then the biggest gainer seems to be the financial counters, which have gone up more than 3%. That's pushed higher by the banking stocks, 4.63% to the good. Just late yesterday, we got word out of Nedbank that things are said to be worse than expected. That earnings picture is bound to be dire. We'll unpack it in a moment or two now with Warwick as well. Then some positivity as well for the industrial. So all of that has managed to push up the All Share to 0.6% to the good, but there is some weakness though. The gold shares have gone down 3.6%, with platinum counters going down 2/3%, then, which means that the overall picture for resources is 1.2% weaker, so weakness across the board there. In terms of the companies to look out for, City Lodge has gone up 8.8%, so too has Sun International, which is 8.3% to the good, so perhaps we'll find some gains in that front. Pan-African Resources though, the platinum miner rather, going down unfortunately 5.5%. DRD Gold, Harmony, who of course now have announced yesterday that they will be seeing the appointment of a new CEO very soon, and that's in about a year's time then as well, as we continue to see some of the gold miners indeed go off into a different space. Sibanye Stillwater, should I say, 4.1% weaker as well, so big losses on that front, which of course just emulates exactly what has gone down with that gold counter. They're going down 3.5%. Onto the commodities board then, you'll see a lot of red here as well when it comes to the Brent crude picture, which has gone down 1.33%. More OPEC countries are asking just to try to keep up with regards to the supply cuts which continue to be enforced on that front. The US crude market also not doing necessarily as well as one would have liked, so we're seeing that price go down 1.33% at $44.32 a barrel. It's just above $900 a fine ounce for platinum, which has fallen 1.2% so far this afternoon, with the gold price sitting just below, still below that $2,000 a fine ounce mark. It is slightly weaker now, having rallied so dramatically as well to hit as close to $2,100 a fine ounce earlier on last month as well. Also then checking in on the currencies, pretty much some positivity for the local currency, but not much to write home about still. 17.21 across that board. The euro sitting at 20.29. A British pound will set you back 22 rand and 61 cents. All of those, though, still some strength for the local currency. Let's have a chat then to Warwick Lucas from Galileo Capital, who joins us as well via Skype. Warwick, I hope you're well this market. Positivity out in Asia. You see the likes of Apple, of course, hit that $2 trillion mark earlier this week. We also saw Tesla, though, get to $2,000 a share. So the tech stocks seem to be all you can invest in a time like this.
Yeah, good afternoon, Arabella, and to the viewers. I guess that the announcement of weak economic conditions continues to act as a goad towards investors looking for the Fed and the government, for that matter, to continue to maintain a very dovish and accommodative stance. Indeed, we see, for example, ongoing discussions between the Democrats and Republicans as to how much the next round of fiscal stimulus will be, and the points of departure is whether it'll be one trillion per the Republicans or 3 trillion per the Democrats. So clearly anticipations of ongoing assistance and stimulus there outweighing consideration of the continuing real economic impact of the virus.
Yeah, the economic impact as well has certainly hurt some companies. Nedbank posting that with which you could clearly see that their earnings are bound to go down, following the likes, of course, then of Standard Bank showing that negative picture. First Rand is bound to show that as well. And then you also have Nedbank's ABSA's earnings set to come out very soon. The banking picture is actually not looking as good as one would have thought.
Well, it certainly looks tough, and you'd expect it to reflect a tough environment. I see that, for example, when Nedbank talks about its credit loss ratio, i.e. loans it's looking to write off, the normal band is about 0.6 to 1% that it speaks about, and this ratio is going to come in at 1.9%, which was even higher than the global financial crisis in 2008 number of 1.6%. So clearly some very tough times indeed. And then of course the likes of non-interest income also down. I mean, if there's less people employed, less people being active and going out, well, transactions are also going to be down. So all in all, a pretty tough picture, and in some ways impressive that Nedbank was able to show positive earnings, i.e. not negative at all. They are still down about 70-odd%, but at least they are still maintaining some earnings there.
What happens to this gold price, though? I mean, we had shot up above $2,000 a fine ounce, and we thought that is clearly going to be the benchmark for some time to come. But it was a bump gain, really, wasn't it? And now we're sitting still languishing at levels we had seen even before that, 1,930. And yet there's still no sense of it's because of just investors fearing for the worst. Was that really the case at that point in time? Were they just worried and decided to go into gold? But now seeing that, well, equities is still the better place to be, despite no gains to be said for now in any of these global economies.
Okay, so I mean, there are basically two key drivers of the gold price in the current environment. The one is that global political uncertainty indices are at much higher levels than they have been for many, many years, since the early 90s, I would say. And that is the one element there. And that's, of course, encompasses both COVID and trade situations and the pressure on globalization. And the other is the more mundane but still very relevant question of what is going to happen with long-term inflation. Now, in terms of the inflation question, we are going to see a presentation by the Fed at the so-called Jackson Hole Conference, which for the very first time will be a virtual one. And in fact, you will be able to see the Fed governor speaking live on the Fed's YouTube page, and that happens next Friday. So that should be a very important point. But the implication is that it would appear that, from early indications, that the Fed is very likely to allow inflation to start running hot for a while, instead of simply letting rates go up at the first whiff of inflation, which has tended in the past, of course, to act as a brake on recoveries. This time, I think, looking at and knowing how fragile economies are, I think the Fed has probably no inclination to hike rates for quite some time. So that I think is quite an important sea change, and it's going to matter widely for equity markets, gold markets, and many other markets for that matter.
Yeah, let's see where it goes to then for next week and the remainder of this month, as well as we get into the latter part of this year, and hopefully things begin to open up somewhat, and not just with regards to level 2 of this lockdown, but certainly with regards to the entire globe as well. Hopefully things can begin to ease off. Warwick, always good chatting to you. Thank you so much for the time. Warwick Lucas from Galileo Capital. So a market picture that looks a little bit pretty, if you want to call it that. The Rand strengthening ever so slightly. The JSE All Share in a better state as well. But Enough about that. My colleagues are standing by. Diabo Setu